So, after enduring weeks of nearly every finance YouTuber seemingly talking about the imminent crash, the Fed spoke this week and the market has responded. It's not the immediate doom everyone was expecting, but still the videos continue and nobody's talking about what this really means for investors over the next year or so and how you can make money and avoid the biggest pitfalls, until now. I've also seen a bunch of just incorrect videos on this topic too, which as somebody who works in full-time investing role just triggers me a bit. So in this video, I'm going to break it down into super simple terms, touching on not only stocks, but at crypto too, what's happened, what this means right now, and what investors can do over the next year or so to maximize their returns. Now, this isn't going to be a fear-mongering, clickbaity, misleading video, as that's not what this channel is about. Bear with me, I'm confident that if you stick with me through this video, you will feel more equipped to handle the market conditions over the next year or so. Before we get into it, smash the like button, subscribe for more investing related content, and most importantly, I'm not a financial advisor. This video is purely for educational and entertainment purposes only. But with that out of the way, what are the key takeaways from the Fed meeting? On a basic level, it was a hawkish meeting. Now in simple terms, that basically means that the focus of the meeting was controlling inflation through the use of interest rates. The alternative would have been a more dovish meeting, where the focus is more around economic growth and job creation. So this was a hawkish meeting, with a strong focus on controlling inflation, which was what was expected by the market. We know that leading up to this meeting, the previous commentary around inflation not being transitory, again, in super simple terms, inflation not being something which will pass in a very short period of time, and instead being something that is here to stay with us for a longer period of time. Now, as a result of this rhetoric before the meeting, the market reacted, and a number of interest rate hikes seemed to be priced in by investors, and our higher beta asset classes and growth stocks were hit the hardest. Now, during the meeting, despite the acknowledgement of the need to introduce some increases in interest rates, the Fed did acknowledge that this was not a rigid and set-in-stone approach, and that they would react and respond to the broader market dynamics. This dovish note was well received by the market, with the Fed acknowledging that they won't just tank markets without recognising the lag impact which such measures and such monetary policy can have. There's also the potential for the Fed to be accepting of higher levels of inflation than they have done previously, and this is also an important dynamic to keep in mind here. The market was expecting a much more rigid approach to this monetary policy, as has been done previously, and so the Fed accepting a more flexible and strategic approach, and this approach was received well by the market, with stock prices performing quite well. So now we know exactly what has happened. What does this actually mean for us as investors and our portfolio over the coming years? So the most important thing here to remember is that there will be interest rate increases. We know, and we've covered why this is the case in previous videos on this channel, that interest rate increases are bad for the valuations of higher beta asset classes, that being growth stocks and crypto being good examples of these. These interest rate increases are coming, and the Fed has confirmed that. Now maybe this is slightly less than the market had priced in originally, but they are coming. All of this update has done is provide a window of opportunity for investors, a couple of months of grace maybe, where good returns can still be generated over that period of time until quantitative easing ends. Let's be real here. 2022 will be tougher in terms of generating stronger returns than other years have been recently. Of course, it is still possible, and we will discuss exactly how, but it will be tougher for sure. Now let's touch on quickly why I say this. If this is too technical, feel free to skip using the chapters below, but I do think this is such an important point that nobody is talking about. Firstly, the fiscal cliff which nobody is speaking about, $6.6 trillion since the pandemic began. That has been a big component and a big driver of growth across all asset classes over the last 18 months. Say this decreases to $1 trillion next year. That will be the largest fiscal cliff in the history of the world economy. Let that sink in for a second. I'm struggling to see how we can achieve any growth next year in excess of GDP with that enormous fiscal cliff. Now, anyone who sees this differently, please reach out, as I'm all ears on this topic, but personally I just can't see it. Now then, on top of this, you overlay the tightening of monetary policy and the increasing of interest rates. This constrains growth further, decreasing propensity to spend and increasing propensity to save. The challenge I always get to this is, wait, Alex, hold up. Consumers are well off financially and are well capitalised. Now yes, this is obviously very true on an aggregate basis. However, when you disaggregate it, you see that 65% of wealth is concentrated in the top 10% of consumers. Well, those top 10% of consumers only account for around 25% of consumption. So how do we plug the other 75%? Oh, and in addition to this, the bottom 50% of households by household network, they account for about 2% of the wealth. On top of this, I'm guessing that that 2% of wealth is now gone because of this around 7% inflation that they're currently facing. So with that being said, I think there will be quite a lot of pain next year if investors are not careful and do not give massive considerations to the positions that they're currently in. Now this leads us very nicely onto the next point, and one which probably everyone wants to get to in this video, and that question is, what should we be doing about our investments and what should we be worried about? Now I think this can be broken down into three main buckets, which we'll go through in order. The first of these is the type of businesses and characteristics which the companies you're invested in may have. The second is time horizons for your investment, and the third is market liquidity. So first off, types of businesses which you're invested into and the characteristics. Now clearly certain businesses will be impacted by a greater degree than others. This is where having a really strong grasp of your portfolio is essential. Businesses which generate the revenues from consumers, where demand is discretionary and that are highly levered with significant debt on their balance sheet will be harder hit than, say, a mission-critical provider of software would be. Now let's run through this example and put a bit of flesh on the bones. Now as demand decreases, the company which is selling products which have discretionary demand will experience decreased sales. Inflation in the market will also inflate the company's cost base, and both of these dynamics have an impact on the gross profit and EBITDA which that company generates. On top of that, if the company has a lot of debt, the increased interest rates will drive increased financing costs for the company, further decreasing the net income, which directly translates to EPS. Now let's contrast this to a company which is B2B focused, business to business focused, and provides mission critical software with non-discretionary demand. Companies cannot cut costs as what they're being provided is essential, so revenues should be fairly robust and resilient. Given the scalability of software offerings, there perhaps only be a minimal impact from inflation on the gross profit, albeit wage inflation is not at the same level as other areas in the supply chain where the majority of disruption has occurred. Now this also plays into the growth potential of the business and the ability on it to deliver its growth strategies. A company which is providing mission critical services and products that are underpinned by strong growth tailwinds are clearly better positioned to deliver on forecast growth versus those where demand is entirely discretionary. Now while these are two fictional companies, hopefully this gives a clear view of how the two businesses could fare very differently in the market conditions which we can expect over the coming year. Of course, all of this will come out in the wash during the earnings over the course of next year. Now the next really important thing here to think about in regards to your investing is time horizons. Are you expecting to hold this investment for many years, in which case some volatility over the next 12 to 18 months is really not much of an issue for you? Now that's only true if you have the right mindset to be a long-term investor and you're not going to be overly worried by small daily movements in the stock price. Alternatively, if you have a shorter term time horizon in mind, then clearly this is something which is important to consider, where the market volatility is likely to be a greater issue for you. Now this leads really nicely onto the final point, which is liquidity. Now I think this is something which is often completely ignored or overlooked by retail investors, but is very much on the agenda of professional investors. The market growth over the last 18 months has been fueled by buyers, outweighing sellers. As we enter 2022, many are expecting a liquidity issue in the market. Again, this has been discussed on the channel before, but the main issue here is that many may be looking to sell at the same time with limited volume on the buy side, resulting in stock prices falling much more rapidly than investors may currently be expecting or be anticipating. Be aware of this, as a sudden rush to exit from a big group of investors could lead to a much larger stock price decreases than we have seen historically to date. And I think this lack of liquidity in the market is something which will play a much bigger feature in the market in 2022, but of course it's barely being discussed on YouTube sadly yet. Now the key takeaway from all of this here is to make sure that you understand exactly what you own, how likely it is to be impacted by the market dynamics. Then, knowing that, make a decision on the basis of this and the time horizon you're prepared to hold that investment for as to what the right strategy going forward is. Now the final thing here to discuss in this video is crypto, and especially what 2022 holds for it and whether the correlation which we're increasingly seeing between the S&P and broader markets is something which will continue or not. Now I've made calls on this channel before which at the time have been very unpopular but subsequently have been right, and I have been able to profit on those in relation to crypto. Now to set the scene a little, as somebody who has been involved in the crypto space for approaching half a decade now, the goal has always been more institutional adoption and ownership. Now, whilst we clearly have seen a lot of this throughout 2021, the massive growth in crypto which many were expecting in Q4 has not materialised. Now, institutions are still adopting, but it takes time as they have many hurdles and hoops they need to jump through. These are not nimble organisations, they're big investors, and that all takes time. One observation during Q4, however, is that increasing correlation between Bitcoin, Ethereum and the S&P 500. Now why is that happening, and will this be something that continues? Now this is a $1 million question, however it's something to expect with more institutional ownership, and the way they work is they are weighted towards different asset classes on the basis of their risk appetite. So say an investor, a bank, allocates 2% of their capital to crypto. So then if crypto as the asset class outperforms others, then a rebalancing will need to occur. Whether that happens quarterly, semi-annually or annually, a portion of that capital which increased will be sold in order to ensure the allocation remains at 2%. So just to walk through that as another example, to walk through that as a very quick example, they originally allocated 2% of their portfolio in crypto. The asset class has grown more quickly than others, so that at the point of rebalancing is around 4%, say. They would then need to sell half of their crypto holdings in order to bring that back down to 2%. Now, the more institutional capital that flows into crypto, the more this becomes a meaningful dynamic and is something that we as investors need to be aware of and need to understand and even optimize our own investing strategies to capitalize on that. Now, as we discussed before too, the liquidity issue is true in crypto as well. So should we see periods of sustained selling, there's every possibility we'll see some greater volatility in prices than we have done before. Now, there are ways to play this and to generate great returns with this in mind, and I will cover that in a separate video on my strategy on how I do that in another video. Anyway, in summary, clearly the doomsday videos which were all over YouTube ahead of the Fed meeting were a little presumptuous, and subsequently many of the videos I've seen encouraging people to blindly buy the dip, again, are probably a bit misleading. My personal view is that there's probably a couple more months of healthy market conditions where wise investors should carefully review their portfolios and the companies they're invested into and rationalise this down to the most robust, resilient and high quality businesses to be invested into. I think there are likely to be more surprises during the course of 2022 too, which nobody can predict, but I do anticipate 2022 being a tougher year for investors across all asset classes. Anyway, that's it for this video. If you did enjoy it, please smash the like button. If you're new to the channel and want more investing related content, then make sure you're subscribed. And please let me know your thoughts and comments in the comment section below. I find it so interesting to hear all the different opinions and perspectives, so please get involved. Thanks again for watching, and I'll see you in another video.